You're watching Aardvark Tax TV. I'm Sean Kennefick, an enrolled agent and customer service representative here at Aardvark Tax. In this video, we're going to talk about royalties and passive losses. This video is part of a complete continuing education course available at our website, www.aardvarktax.com. Let's start with royalties. Royalties are a usage-based payment system made by one party to another for the right to the ongoing use of an asset. There are many different types of royalties, but you may be most familiar with them as they're applied to intellectual property. For instance, a songwriter often receives a royalty every time a song for which he owns the publishing rights is played on the radio. In other cases, a screenwriter's royalties might be based upon a box office return. The payment methodology between the two parties is completely up to the licensor and the licensee. There are no set rules for royalties amounts unless they're dictated by another type of agreement, such as one where a union negotiates with a set of publishers, for example, for a standard rate of royalty returns. Royalty agreements might be finite or infinite until the copyright in question falls into the public domain. But royalties aren't used for intellectual property alone. Another standard way to use royalties is when you own the oil or mineral interest rights for a piece of land. For example, when a petroleum company wants to drill for oil on a person's land, the company negotiates a royalty agreement with the owner of the mineral rights. If the company strikes oil, then the owner of the mineral rights will receive a royalty based upon a percentage of the barrels pumped out of the wells. The owner may receive the royalty in kind, such as real actual oil, or it might be based upon the dollar value agreed upon in the contract. The total production from the property often indicates how much royalties will be. In many cases, the royalties in these situations are determined by the amount of material that the licensor extracts, such as the amount of oil in the case I just mentioned, but the exact amount is always determined by the initial contract. For the most part, royalties are reported on Schedule E, which is a better place to report them because they are not subject to self-employment tax. But in other cases, you must report them on the Schedule C, such as in the case where you received royalties from your professional efforts as a self-employed writer, inventor, or artist. You must also report royalties from oil or mineral working interest on Schedule C. A working interest is different from a standard royalty interest in that it is not limited to an initial investment amount. Whenever you report your income on Schedule C, it's subject to self-employment tax, so these types of royalties are also subject to self-employment tax. The right to royalties does not end when people die. Copyrights and land ownership get inherited by beneficiaries who can then claim the royalties to themselves as dictated in the original contract. The royalties would then continue until the property in question is disposed of or falls into the public domain. Now let's talk about active and passive income. Federal tax law differentiates between active, passive, and portfolio income. Yes, you still generally have to pay tax on all of that income regardless of what it is in the year it was received, but the difference lies in how you're allowed to take its losses. Active income is income where you generally used your labor to earn it. Getting wages or running your own business are examples of active income. Passive income is different because it's income that is considered to be unearned. You didn't have to use your own labor to make it happen. Examples of passive income include income from rental properties that you didn't manage and earnings from a business where you weren't involved and didn't use your own labor to generate income. There are other types of passive incomes, but the IRS typically categorizes them differently, and the passive income rules don't apply to them. These types of income include royalties, pensions, and portfolio income such as dividends and stock gains and losses. Why does it matter whether income is active or passive? It's because the IRS differentiates how you can take losses against the income. For instance, if you have a $10,000 loss on a rental property and the only other passive income you have is another property where you have income of $1,000, you might only be allowed to take a loss of $1,000, which evens you out. And then you have to carry the other $9,000 in disallowed losses to future years. If both of those activities were active or ones in which you materially participated, you would be able to take the entire $10,000 loss this year and apply it as a deduction against your other wages and investment income. If you're affected by passive loss limits, you might find your passive losses continually carried over and over and over and trapped until you dispose of the affected property in later years. For that reason, many people don't like these passive loss limits. Passive business losses always fall under the passive activity loss rules. However, if you materially participate in the business, you can treat its losses as active. A taxpayer is determined to have materially participated in a business if that taxpayer participated in the activity for more than 500 hours, the taxpayer's participation was substantially the bulk of participation in the activity while taking into consideration the participation of anyone else who might have been involved, the taxpayer participated in the activity for more than 100 hours and participated at least as much as anybody else. You can also get around the passive loss limit rules if you have recently materially participated in an activity, even if you don't anymore. For instance, a taxpayer is determined to have active income instead of passive income if the taxpayer materially participated in the activity for any 5 of the 10 immediately preceding tax years, or if the activity is a personal service activity in which the taxpayer materially participated for any 3 preceding tax years. Now, personal service activities include things like things that are licensed or certified, such as those services provided by doctors, lawyers, licensed engineers, architects, certified accountants, and consultants. If you own a rental property, you might find that the rules I just discussed apply to you and allow you not to apply the passive loss limits. If so, that's great. But more likely than not, you won't be able to do that. There is a second way to avoid the passive loss limits as a rental owner. It's called the small landlord exception. If you qualified, you're allowed to currently deduct up to $25,000 of passive losses from rental real estate properties, even if you have no other passive income. You must own at least 10% of the property generating the loss, and you must be considered to have actively participated in the management of the property. Passing the active participation test is pretty easy. All you have to do is prove that you at least exercise management control over the property in question by, for example, interviewing prospective tenants, approving leases, or authorizing maintenance and repairs. You don't necessarily have to mow any lawns or unclog drains to qualify for this break, but you can't have hired a management company to do everything either. Unfortunately, there is an income limit to the small landlord exception. This exception is phased out for all filing statuses between $100,000 and $150,000 of adjusted gross income, except for married filing separately, where the phase out is lower. As an example, say you have $31,000 of rental real estate losses and your AGI is $120,000. Under the phase out rule, your current deduction is limited to only $15,000, and you must carry over the remaining $16,000 in passive activity losses to the next year. If your AGI is $150,000 or higher, you're completely ineligible. Now you are back under the general passive activity loss restrictions, meaning you can deduct passive losses only when you have some passive income or in the year that you dispose of the losses property. Passive loss limits are a double-edged sword. Not only do they generally work against the taxpayer and in the government's favor, but they are also complicated. If you have passive losses, you need to use Form 8582 to determine how much of the loss you can apply to the current year and whether you have to carry any of the rest of the losses over to future years. This video has been part of a tax continuing education course available at www.aardvarktax.com. The course has been approved by the IRS and state governing agencies like CTEC and Oregon's Board of Tax Practitioners. But just viewing the video alone won't get you credit for your governing agencies. Instead, be sure to register for this course or any of our other courses by heading to the aardvarktax.com website. And when you've completed, we'll report your success to the government agencies and make sure you get credit.